$11,625 a year for the lowest cost bronze plan, and $15,914 for benchmark silver. Those are KFF's national 2026 figures for an unsubsidized 60-year-old. So the $14,000 invisible bill is a useful midpoint, not a published official average. Now, move one number. Household modified adjusted gross income. At 150% of the federal poverty level, that means $23,475 for one person, or $31,725 for a couple in the continental United States. The maximum contribution toward the benchmark plan is about 4.19% of income. For the single person, that is roughly $984 a year, or $82 a month. A cheaper local plan could approach a $0 premium, but zero is not guaranteed. Your actual result depends on your age, zip code, household, local prices, and the plan you select. That difference can turn the decade before Medicare from a six-figure liability into something your portfolio can absorb. Freeze today's prices for illustration, and 10 years of that bronze premium would total $116,250. 10 years at the national benchmark. Silver figure would total $159,140. That is not a forecast, because premiums, subsidies, your age, and your household will change. It is a scale test. A portfolio supporting $60,000 of annual spending may need another $140,000 or more reserved for insurance if you assume full price. That reserve can delay retirement by years. Age explains why the sticker price is so ugly. Under ACA rating rules, an older adult can be charged up to 3 times the rate charged to a younger adult. Your medical history cannot raise that premium, but age and location can. By your late 50s and early 60s, the full price has had plenty of time to become rude. Age is largely outside your control. The second pricing dimension is not. For 2026 marketplace credits, picture a MAGI dial with 3 single-person markers. $23,475 at 150% of poverty. $39,125 at 250%. And $62,600 at 400%. For a couple, the first marker is $31,725, and the upper marker is $84,600. Alaska and Hawaii use different poverty figures, so those residents need their own map. Advice based on 2025 rules can now produce an expensive error. The enhanced premium tax credits expired after December 31st, 2025. During their temporary life, the benchmark contribution was capped at 8.5%, and income above 400% of poverty could still receive help. Current 2026 law restored the upper eligibility cliff, while the required contribution scale rises as high as 9.96%. KFF estimated that subsidized enrollees keeping the same plan would see their premium payments rise by an average of 114% after the enhanced credits expired. That is not a political prediction. It is the current calculation, and the IRS updated its guidance in 2026 to reflect it. I built a digital book called The Exit Code, and part of it treats this pre-Medicare insurance gap as an annual portfolio liability instead of a vague retirement fear. The link is in the description if you want the full framework. The credit calculation is less mysterious than the vocabulary makes it sound. The marketplace finds the second lowest cost silver plan available to your coverage household. That is the local benchmark. It calculates the contribution expected from you based on household MAGI and subtracts that contribution from the benchmark premium. The remaining amount is the premium tax credit, limited by the premium for the plan you actually enroll in. If the benchmark costs $15,000 and your required contribution is $1,000, the credit can be approximately $14,000. An older eligible person may receive a larger dollar credit than a younger eligible person because the older person's local benchmark premium is higher. The income contribution is the anchor. The credit absorbs much of the price above it. That equation does not give every person earning $23,475 the same monthly bill. Your benchmark is local. A 60-year-old in one county may face several insurers and aggressive pricing. Another county may have fewer plans and a far more expensive benchmark. Your credit then follows that benchmark, but you can generally apply it to an eligible bronze, silver, or gold marketplace plan. If your chosen plan costs less than the benchmark, the credit may reduce its premium to a very small amount. It cannot pay you the unused difference as monthly cash. If your chosen plan is more expensive, you pay the amount above what the credit covers. This is why the phrase nearly free ACA coverage can be accurate for a particular quote while still being dishonest as a universal promise. By the way, clicking subscribe helps a lot if you value finance built from the actual tax rules rather than recycled assumptions. So thank you to everyone doing that. The premium is only 1 meter. The other meter is what happens when you use the insurance. Bronze normally trades a lower premium for higher deductibles and greater cost sharing. Silver sits in the middle until cost sharing reductions change it. Those reductions can lower deductibles, co-payments, co-insurance, and the maximum you may have to pay for covered in-network care. They are available only when you enroll in a silver plan. You can use a premium tax credit on another metal level, but you lose the additional cost-sharing reduction. A $0 bronze quote and an $82 silver contribution are therefore not competing versions of the same product. One may expose several $1,000s more of your portfolio when you need care. The honest comparison is annual premiums plus expected medical spending plus the plan's worst-case in-network exposure. That makes the 150% marker unusually powerful. At or below that boundary, qualifying silver coverage reaches approximately 94% actuarial value. Actuarial value does not predict your personal bill. It estimates the share of covered costs that the plan pays across a standard population. Still, 94% is far richer than standard silver at roughly 70%. For 2026, the federal maximum annual cost sharing limit for self-only coverage in the strongest silver reduction band is $3,350. Although an individual plan can set lower amounts and its deductible structure still varies. Combine that richer coverage with a benchmark contribution near $984 and $23,475 becomes more than a low premium marker. It is the upper edge of the strongest silver assistance band. Because an unexpected dividend can move you across it, treat it as a boundary requiring room, not a bullseye. Move the MAGI dial upward and the system changes in layers. At 250% of poverty, or $39,125 for one person, the illustrative maximum benchmark contribution is about $3,302 annually, roughly $275 a month. Cost-sharing assistance has weakened by then, and it ends once income moves above the 250% boundary. At 400%, or $62,600, the maximum benchmark contribution reaches about $6,235 annually, close to $520 a month. Those figures assume the local benchmark is expensive enough for a credit to exist. If the benchmark costs less than your calculated contribution, there is nothing left for a credit to cover. MAP, then a generic claim that ACA insurance is cheap or expensive. Near 150%, you may receive both a large premium credit and the richest silver cost-sharing reduction. At 250%, the premium assistance can remain meaningful, but the medical cost protection is less generous. At 400%, you remain technically eligible for a premium tax credit under current law, yet you are contributing almost 10% of household income toward the benchmark. $1 above that upper boundary changes the shape of the graph. The contribution does not continue upward in a smooth line. Eligibility for the credit ends. Use a national 60-year-old benchmark only as an illustration. At $62,600 of MAGI, the calculated benchmark contribution is approximately $6,235. If income lands above the 400% boundary and the national benchmark happens to resemble your local price, the bill could move toward $15,914. That is about $9,679 of additional annual exposure created by crossing an income line. Your personal difference may be smaller or much larger because your location controls the full premium. KFF found enormous geographic variation for older buyers. The non-negotiable point is that current law contains a cliff, and a large capital gain, Roth conversion, or retirement distribution can push you over it after the coverage year has already happened. The number tested at tax filing is ACA Household MAGI. Start with adjusted gross income from line 11 of Form 1040. Add tax-exempt interests, non-taxable Social Security benefits, and excluded foreign income. Supplemental security income is not added. There is no line on the return labeled ACA MAGI. which is a charming design choice for the number determining thousands of dollars of health assistance. Household income generally includes the MAGI of you, your spouse when filing jointly, and tax family members who are required to file a return. Municipal bond interest may be tax exempt, yet still raise ACA MAGI. Part of Social Security may avoid ordinary income tax and still return through the ACA calculation. The tax code manages to make not taxable and counted as income coexist peacefully. Assets do not appear in that test. Your home equity is not added. The balance of a brokerage account is not added. A $2 million portfolio does not automatically disqualify you. Marketplace assistance looks at annual household, MAGI, not net worth. This is statutory design, not a loophole. The distinction matters because a retired household may be asset-rich while generating a controlled amount of taxable income. A worker earning $200,000 on a W-2 has limited control over when that salary appears. A retiree with cash, taxable investments, pre-tax accounts, Roth assets, and perhaps an HSA may have several ways to fund the same lifestyle. The balances do not set the subsidy. The tax character of the cash leaving them does. Pre-tax retirement distributions generally enter adjusted gross income. A distribution from a traditional IRA or 401k therefore consumes MAGI headroom. The taxable portion of a Roth conversion does the same, even though you moved money between accounts rather than spending it. Qualified Roth distributions are not included in gross income. Cash that was already taxed does not create new income when you spend it. In a taxable brokerage account, sale proceeds are not automatically income in full. The gain above your basis affects AGI, while the return of basis does not. Dividends, interest, and capital gain distributions can create MAGI even when you reinvest them. Tax losses may offset gains within the tax rules. Eligible deductible HSA contributions can reduce AGI, while qualified HSA distributions used for medical expenses generally do not add taxable income. The qualifications matter. A Roth distribution is not automatically qualified because the account has the word Roth on it. Age, holding periods, contribution basis, and conversion rules can affect treatment, especially before age 59 and a half. Selling $10,000 of stock does not mean you withdrew $10,000 of principal. Every lot has a basis and a gain or loss. An HSA contribution requires eligibility. This is why you project from tax records, not from account names. The broad pattern is still powerful. Pre-tax income and taxable gains feed the MAGI dial, while qualified Roth cash, existing cash reserves, return of basis, and qualified HSA withdrawals can fund spending with little or no addition to that dial. Imagine a single 60-year-old who needs $60,000 of cash for the year. Ignore other income for a clean illustration. If the entire $60,000 comes from a fully taxable traditional IRA distribution, MAGI is approximately $60,000. That is below the $62,600 cliff, but only by $2,600. At that income level, the expected benchmark contribution is roughly 9.96%, or $5,976. The insurance premium itself must now be funded, and almost no room remains for dividends, interest, gains, or a conversion. Now fund the same $60,000 lifestyle differently. Generate $23,475 of MAGI. Then add $26,525 from qualified Roth distributions and $10,000 from cash or return of taxable basis. The household still spends $60,000. The projected benchmark contribution falls to roughly $984. Same age, same zip code, same lifestyle, potentially the same total net worth, yet the contribution differs by almost $5,000. The feasibility depends on owning the right account mix and having lawful access to the cash. The example is not a universal recipe. It proves that spending and MAGI are different measurements. That changes the meaning of the insurance problem. You are not primarily shopping for a cheaper policy. You are engineering retirement cash flow so the tax return and the lifestyle can coexist. The question becomes whether your portfolio can deliver the money you want to spend while creating an acceptable amount of MAGI. A household with most of its wealth in pre-tax accounts may find that difficult. Another household with the same balance spread across taxable basis, Roth, money, cash, and pre-tax assets may have far more control. Portfolio size tells you how much fuel exists. Account location determines how much smoke appears on the tax return. The tension arrives when a smart tax move collides with a smart insurance move. Suppose you want to convert $30,000 from a traditional IRA to a Roth, while ordinary tax rates are manageable. That conversion increases MAGI by the taxable amount. Near 150% of poverty, it can weaken cost-sharing reductions and increase the benchmark contribution. Near 250%, it can end cost-sharing assistance. Near 400%, it can erase the premium tax credit. A conversion may still be worthwhile if it reduces future required distributions, future taxes, or future Medicare-related premiums. The cost of the conversion is not limited to federal and state income tax. During the gap years, you also price the lost ACA assistance. This creates a genuine two-option arbitrage. Converting more today can improve the future tax structure while raising today's health insurance bill. Converting less can preserve the current subsidy while leaving more pre-tax money for later. There is no permanent winner independent of your numbers. You compare the marginal tax on the conversion, the added premium, the possible loss of cost-sharing reductions, future required distributions, and the number of ACA years remaining. A conversion at age 64 affects perhaps one final coverage year before Medicare. The same conversion at 55 may alter a 10-year income plan. Time changes the answer because the insurance consequence repeats. The available levers follow from the cash flow problem. A larger pre-tax distribution raises MAGI, which may require a smaller conversion. A qualified Roth withdrawal can cover spending without using that headroom, preserving room for taxable gains or deliberate conversion. Selling taxable assets with high bases may produce more spendable cash per dollar of reported gain. Selling low basis assets can do the opposite. Realized losses may create room, while an unexpected mutual fund capital gain distribution can consume it without your permission. If you remain HSA eligible, a deductible contribution can reduce AGI, and qualified medical spending from an existing HSA can avoid a new taxable withdrawal. None of these controls operates alone. Each changes the remaining capacity beneath the selected MAGI ceiling. Traditional retirement advice often says to maximize the pre-tax 401k, apply a withdrawal percentage later, and wait until 65 because Medicare will eventually solve the insurance question. That approach can build a large portfolio with poor flexibility during the exact years when flexibility has the highest price. If nearly every dollar you spend must leave a pre-tax account, nearly every dollar presses the MAGI dial upward. A smaller household with multiple tax buckets may control ACA costs more effectively than a wealthier household trapped in one bucket. The failure is not saving too much. It is measuring retirement readiness by total balance while ignoring how the balance becomes spendable cash. The insurance bill then pushes back into the calculation. Say your planned lifestyle requires $60,000 before premiums. Your selected plan adds $6,000 of annual premium and perhaps a medical reserve. If you fund that extra amount with a pre-tax distribution, MAGI rises. The higher MAGI increases your expected benchmark contribution, which raises the cash you need again. At a 9.96% contribution rate, another $1,000 of MAGI can add nearly $100 to the benchmark contribution. This feedback loop is not infinite, but it means the premium cannot be pasted onto the plan after the income projection is finished. Spending determines withdrawals. Withdrawals influence MAGI. MAGI changes the premium, and the revised premium changes spending. The final tax return settles the score. Advanced premium tax credits are based on the income estimate you give the marketplace, but the actual credit is reconciled on Form 8962. If your real MAGI is higher, you may have received more advance assistance than allowed. Beginning with tax years after 2025, the former repayment caps no longer protect you. The excess can require full repayment. A moderate miss within the eligible range normally means repaying the difference between the advance credit and the smaller credit you actually earned. Crossing above 400% is harsher because current law can reduce the allowable premium tax credit to zero. A surprise gain in December may therefore become a health insurance bill on the following tax return. Knowing these numbers and building a system around them are two different things. I built a digital book called The Exit Code, an analysis of 50 years of actual retirement data distilled into a mathematical framework for exiting the rat race. It includes the $14,000 invisible bill, the insurance gap that can wreck an otherwise workable exit before Medicare, and the framework that turns maybe someday into a specific, testable date. It also shows how withdrawal decisions interact with the rest of the plan instead of treating healthcare as a separate estimate added at the end. You can get it for less than a dinner out through the link in the description. The urgency is not marketing. Every additional year of poor tax placement reduces the flexibility available when employment income stops. The safer target is a MAGI band with headroom, not an exact point. If your preferred band ends around $23,475, your working projection needs room below it for interest, dividends, year-end distributions, side income, and gains you have not realized yet. If preserving some premium tax credit requires staying below $62,600, landing at $62,599 is technically clever and behaviorally ridiculous. Income estimates change. Tax forms arrive late. A fund can distribute gains. A small consulting payment can become larger than expected. The right cushion depends on how volatile and controllable your income sources are. Stable pension income needs a different reserve from a concentrated stock position or irregular business income. You can also choose how much of the estimated credit to receive in advance. Taking the full advance amount minimizes monthly premiums, but increases the amount exposed to reconciliation if income rises. Taking part of it in advance creates a larger monthly bill and a smaller potential repayment. Taking none means paying the premium during the year and claiming any allowable credit on the return. That choice does not change the credit you ultimately earn. It changes cash flow and repayment risk. For someone with uncertain gains, partial advance credit may be easier to sleep with. For someone with highly predictable income and adequate headroom, the monthly reduction may be more useful. The best setting is the one your cash reserve can support without forcing another taxable withdrawal. Aiming lower is not automatically better, because the bottom boundary is state dependent. Marketplace premium credits generally begin at 100% of the federal poverty level, subject to limited exceptions. In Medicaid expansion jurisdictions, eligibility for some adults commonly extends to approximately 138%. Medicaid and marketplace calculations do not always use the same year's poverty table. For 2026 marketplace savings, the markers discussed here use the 2025 guideline available when enrollment began, while 2026 income figures are used for current Medicaid and CHIP determinations. That timing difference is another lovely piece of administrative furniture to trip over. State rules matter more below the marketplace range. Expansion status, household category, and state administration can change the coverage path. Beginning January 1st, 2027, federal law requires certain adults aged 19 through 64 in the affected Medicaid groups to satisfy community engagement requirements, generally through 80 hours a month of qualifying work, education, work programs, or community service, unless an exemption applies. States can implement earlier, and the operational details vary. Because state implementation and legal challenges have altered earlier versions of these programs, a 10-year retirement plan should not assume the lower edge will remain static. Verify it for your state and coverage year rather than driving MAGI downward because a percentage looked attractive. The date you leave employment connects the tax plan to the enrollment calendar. Losing job-based coverage normally creates a special enrollment period, extending 60 days before and 60 days after the loss. Applying before the employer plan ends can allow marketplace coverage to start after that coverage stops, avoiding an uninsured gap. On the federal marketplace, open enrollment generally runs from November 1st through January 15th, while state-run exchanges may use different deadlines. You do not need to schedule retirement inside open enrollment when the loss of employer coverage qualifies you for a special window. You do need to document the loss, select the plan on time, and pay the first premium before coverage becomes effective. COBRA is an option leaving the employer plan, not a mandatory waiting room before the marketplace. You may decline former employer COBRA coverage and still qualify for a marketplace premium tax credit if you satisfy the other requirements. Standard COBRA continuation after job loss generally lasts up to 18 months and may charge as much as 102% of the group plan's full cost, including the share previously paid by the employer. A qualifying disability determination can extend coverage to 29 months, with higher permitted charges during the extension. COBRA can preserve the same doctors, network, and treatment arrangements, which may be valuable. Its cost is often the shock because the employer subsidy disappears. Timing limits the flexibility after you elect it. If you voluntarily end COBRA outside marketplace open enrollment after the original job loss special enrollment window has passed, that choice alone generally does not create another special enrollment period. COBRA exhaustion can. Another qualifying life event can. Open enrollment can. This makes COBRA useful as a deliberate bridge, but poor as an indefinite default you plan to abandon on any random Tuesday. Compare its total premium, deductible progress, provider continuity, remaining duration, and switching window against the marketplace before choosing the lane. Marketplace coverage removes one major fear. ACA compliant plans cannot reject you, charge more because of your health history, or exclude treatment for a pre-existing condition. That does not make every plan interchangeable. Provider networks differ. A doctor or hospital may not participate. Prescription formularies can treat the same medication differently. Deductibles, co-payments, co-insurance, referrals, and out-of-pocket limits vary by plan. Metal levels describe how costs are divided, not the quality of the doctors. The tax credit changes the premium. Cost-sharing reductions change eligible, silver coverage. Neither guarantees that your preferred specialist or medication is in the plan. The final comparison needs the premium, likely medical use, worst-case exposure, network, and formulary on the same page. Your annual control panel begins with the cash your lifestyle requires, including the insurance premium and a realistic medical reserve. Existing cash, qualified Roth money, qualified HSA distributions, and return of basis determine how much of that spending can occur without creating new MAGI. Pre-tax distributions, taxable gains, interest, dividends, non-taxable Social Security, tax-exempt interest, business income, and Roth conversions fill the income side. The projected MAGI then lands inside a poverty-level band, which produces a required benchmark contribution and determines whether silver cost-sharing reductions remain available. Your local benchmark and selected plan convert that statutory result into an actual premium. Only after those pieces fit can you see whether any conversion room remains. Then run the control panel across every gap year. A plan that works at 64 may fail at 57 because the bridge lasts longer and account access rules differ. Social Security changes MAGI when it begins, including the non-taxable portion added back for ACA purposes. Investment income changes as assets are sold. Cash reserves decline. Roth balances may become available under different rules. One spouse may reach Medicare before the other, changing the coverage household and the local benchmark calculation. Poverty guidelines and contribution percentages are indexed, while Congress can change the law again. Retirement readiness is not one ACA quote. It is a sequence of annual tax returns supporting a sequence of coverage years. The psychological mistake is treating an unknown cost as an unlimited cost. Your brain sees the full $15,000 price, multiplies it by 10, adds medical catastrophe, and concludes that another year of work must be safer. Once the bill is tied to MAGI, account location, and a local, quote, fear becomes a model, the model may tell you to delay. It may also show that the portfolio already supports the exit because $60,000 of spending does not need to create $60,000 of income. And if this kind of plain English reading of the boring documents is useful, subscribing helps the channel more than you might think. So thank you. Lazy investing built more fortune than crypto memes. More importantly, knowing the MAGI your portfolio can produce turns 65 from a finish line imposed by an insurance bill into one date among several you can calculate. Your exit age becomes a choice when every gap year works on paper before you hand in the notice. A finish line imposed by an insurance bill into one date among several you can calculate. Your exit age becomes a choice when every gap year works on paper before you hand in the notice.